Good morning and welcome to this Monday, June 13th, 2022 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, I think we're going to start off today maybe wishing we've just been golfing the last week or so. Market not looking very good this morning. It obviously ended the week poorly last week. Cryptocurrencies got absolutely just thrashed over the weekend. We're going to talk about that a little bit. I think we've got probably a lot of margin calls. I think that's going to trigger some additional selling. We're seeing that at the open right now, or at least as we approach the open. Futures currently, well, I looked about 10 minutes ago, but NASDAQ futures were down about 340 points, almost 3%. Dow futures down almost 2%, down close to 600 points. NASDAQ futures looking like we're going to open back down near that intraday low that we saw recently, down around 38.10. Currently, the futures down there about 90. It's just going to be an ugly day. 10-year Treasury yield right now, 3.27%. I was talking about that 3.25 level. The fact that we haven't seen anything above 3.25 over the last 11 years. Well, this morning we're seeing it, 327. Crude oil prices down a little bit this morning, $119 a barrel, but still quite elevated from where they've been in the recent past. It's like the perfect storm, a tsunami, all coming together here. Yeah, this is, we're going to see the market. We're going to find out exactly how resilient the market is. Remember, during the bull market, it was resilient. It kept going higher. Now it's been trying to find bottoms and not go any lower. And so the resiliency I'm talking about now is, can we avoid going down to those new intraday lows? And do we break down at the end of the day? Are we closing on the lows? Those are things that are going to be really important today and throughout the week, along with sentiment readings, VIX, 5-day equity only put call ratio, that moving average. That's what I like to look at. We saw the equity only put call ratio jump at the end of last week. I don't know if you were following, but it was a big number on Friday. I imagine we're going to see a pretty big number today. So we are likely to really begin seeing the resetting of sentiment that I talked about all the way back in December and early January. Anyway, we'll get into all of that. Before we get into that, though, I do want to go over and talk a little bit about EarningsBeats for those of you who are new. If you go to EarningsBeats.com and then just scroll down, we have a free newsletter, EarningsBeats Digest. I'd highly recommend it, not just because I write it, but we do try to make it very educational, and I think you'll learn some things. May just add a little bit to your trading repertoire. Maybe it's just some facts about the market that you didn't know. But 3 times a week, I will send out a very brief article. It's usually just a couple of paragraphs in a chart, just to help explain some of the things that are important to us: the relative strength, earnings, gaps, candlesticks, trend lines, moving averages, those types of things. Mostly technical, but also intermarket relationship, which I still kind of feel like goes under that technical umbrella. But a lot of the things that John Murphy taught me when I went through his books, I'm for the most part self-taught, but I did find a lot of inspiration in John Murphy's work. And that's what I've kind of used to continue my own, studies of stock prices and how they evolve over time. But anyway, if you want to learn more about that, I would highly recommend you go in. It's a free newsletter. There's no credit card required. You can unsubscribe at any time. A lot of times when we run specials, everybody on our EB Digest is going to know about it. So if you do decide you want to become a member, you'll get the best, price possible there. Also, we have a lot of free events, a lot of free webinars from time to time, and we reach out to this community whenever we have those. So it's a great time to make sure, especially with all the volatility and everything going on in the market, great time to join here. So make sure you go in and sign up with your name and email address there. All right, let's talk a little bit about what happened on Friday, because it was ugly. As I told members leading up to Friday, and then Friday morning, I was in a meeting all day Friday, so I really didn't have a chance to follow the action minute by minute. But I did send out a very quick market update on Friday at the beginning, and basically just pointed out a candle that had printed on Thursday where we were breaking beneath that prior area of consolidation. And the thing that's interesting there is back on Monday of last week, I actually wrote to our members and I said, beware this candle. If you're a member, you know exactly what I'm talking about. This is sideways consolidation. What we did not want to see was a big red filled candle. That was Thursday. Friday, we get the follow through, and now look at what we have this morning. I'm telling you, the combination of understanding all the pieces that go into the stock market, the sentiment portion of it, you know, understanding how sentiment plays a key role in the market, the candlesticks, the patterns, just the general market environment that we've been in, where the Wall Street folks are avoiding growth at all costs and continue to stick with value stocks. These are all things that tell us that it's more likely than not that this isn't over. And I've been saying here over the last couple of weeks, I mean, I really want to call the bottom. You don't know how bad I want to call the bottom. I'm not seeing it. The market's not giving me any reason to call the bottom yet. And there are some who've questioned the fact that I say that this is a cyclical bear market and say, no, it's a secular, it's a long term. This thing's just getting started. Well, one beauty of believing that it was a cyclical bear market to begin is I could potentially change my mind. And don't misinterpret, I'm not changing my mind. I still believe this is a cyclical bear market. But it's almost like, you know, because I've had a couple emails and they say, well, you know, you're wrong. This is a secular bear market. Well, cyclical bear markets go down just like secular bear markets. Just depends on how long they last. So I feel like, you know, market's pretty much done exactly what we talked about at the beginning of the year. Those of you that were in the Market Vision forecast that I did back in, I think it was on January 8th, Saturday, January 8th this year, know that I drew a line of the S&P 500 from January 1st down to June 30th, down to 3,500. We were at 4,800. That's a pretty bold call back in January. I saw it going down to 3,500 by June and then turning around and going right back up. I'm sticking by that forecast. I don't see anything different right now than I saw then. The only problem is there's no confirmation of that yet. Wall Street is not moving back into growth stocks at this point. So, I mean, I'm not going to just say, hey, 3,500's here and therefore the bottom is absolutely in. We're going to continue to watch to see how this bear market unfolds. If we get down to 3,500 with a lot of panic and we reset the sentiment like I thought we probably would this year, and that we're pretty much almost there at this point, then it's quite likely, or certainly quite possible, that 3,500 could be it. But there should be other signs. There should be other things that'll tell us that as well, not just the fact that we got there. So there's still a lot to go here. You can't rush. You can't, I keep saying you got to have patience. I have to keep telling myself this every day. You have to have patience. You have to let this market play out. If it turns out that 3,500 is not the bottom and we continue to see growth stocks sell off, I'm not going to say this is the bottom. I'm going to wait until we see the actual rotation start to take place, or massive capitulation. That's the other thing that could mark this bottom. Even without the rotation, we could just get a move down, and maybe it's this week. I don't know. But we could get one of these weeks where we just go down 10, 15% in a week and then have a big rally that last day, big turnaround. And many times that's the bottom. Doesn't wait for the rotation. So there's lots of different ways. I mean, if you study history, a lot of different ways a market can play out. I think you got to be really careful, though, to just go all in. I do believe that in time, if you bought today, even at the open, I think a year from now, I think you'd be really happy. That's my opinion. But I don't have any signs yet to tell me definitively that, hey, this thing is really starting to put in a bottom. So we've got to remain cautious. It really comes down to what everyone's personal preference is. Are you looking to trade the exact bottom? Are you a trader and you want to remain in cash until you really feel like that bottom is in? Then I wouldn't, if that's the case, I wouldn't touch the market right now. Those trading dollars I would have sitting in cash. I'd say, well, why don't you short? Well, you can short, but just be ready to be whipsawed at any point as well. So, I think shorting, if you were going to short, I think it was probably on that breakdown of that consolidation. That was the time to short, when you get that red candle, big red filled candle, to break out of that period of consolidation. To me, that was the signal to short in the short term, if that's what you wanted to do. I personally, I really like just being in cash when the market's going down. I feel empowered with that. Anyway, it was a rough end of last week, as you can see across our major indices. Friday, Dow Jones down 2.75%, S&P 2.9%, NASDAQ 3.5%. There's that rotation continuing to move into the NASDAQ. If there is one positive I see on this chart, is that the Dow and the S&P actually closed right on its support at 3,900. That was closing support. The NASDAQ actually is still above that support. Mid caps and small caps are above that support. So, there is a slight element. We don't know where the low is, so we got to wait for that low. But there is a slight element of, I don't know, maybe like a positive divergence, or, some kind of positive rotation in that sense. I don't know that that's going to be the, thing that's going to trigger this bottom at this point. I think sentiment is probably going to be the first thing we need to watch. I'm going to talk about that a little bit later. Anyhow, from a sector perspective, look what led on Friday: discretionary and technology. Those are really the two key groups, and those are the two groups that represent the highest percentage in the S&P 500. So when you talk those two combined, so when you talk about these two groups getting hit like that, there's no saving the S&P 500. And at the beginning of the year, when I talked about the large cap growth, when they finally rolled over, that's when the S&P 500 would have no defense. That's what's happened throughout 2022. Large cap growth names been absolutely getting annihilated. Financials actually closed at a new low, down 3.6%. Materials down 3%. Industrials down almost 3%. So across the board, just not very good action. Now, one signal that I do think supports the fact that I believe this is a cyclical bear market. Look at these AD lines. Prices keep going down. AD lines actually, the Dow, higher lows, price action, lower lows. The S&P, higher lows. NASDAQ, higher lows. Mid caps, higher lows. Small caps, higher lows. The AD line, I think, is one indication that this is a cyclical bear market, not a secular. If it was secular, there would be no accumulation whatsoever. Wall Street would be bailing on this market. I mean, you might say, well, they already have. Well, they probably did earlier in the year. I mean, remember, that's when the rotation was taking place. That's what was happening. Wall Street was moving from offense to defense back in December and January when no one suspected. It's like they're just hiding in this little room, doing their little thing. Nobody's paying attention because we're still talking about all-time highs on the S&P 500 back in December and early January. So why are you going to worry about the market? New high, new all-time high. Got the cheerleaders out on CNBC. Now you can see what that rotation meant. Pretty easy. All right, 10-year Treasury yield. Let's get the update here. 3.27%. There is that move. We had that negative divergence, saw that lower PPO, higher 10-year Treasury yield, went back, tested the 50, got that center line test. Now what's going on? This is why when you see negative divergences, don't immediately think that's it, that's as high as it's going to go and that, the next year we're going down. Negative divergences a lot of times are just short-term momentum warnings. Short-term. That's all this was. Yield had gone up so much, it was starting to run out of steam. That's what the PPO moving lower with the higher yield told us. And then instead of pulling back and holding a rising 20-day, we went down a little bit further, went to the 50, reset the PPO. Notice here when you go up, you pull back, PPO pulls back a little bit, but we don't go back down to the center line. And we go up, got another new high here. We pull back a little bit. We don't go back down on the PPO to the center line. We go up again, another new high. And it wasn't until this one that PPO rolled over. And that doesn't guarantee us we're going to go lower. It doesn't guarantee us we're going to go back to the center line in the 50-day. It just tells me that the odds are greater. And technical analysis is nothing more than just managing risk and odds and probabilities. People that don't follow technical analysis look at it and say, they'll point to something that doesn't work and say, see, technical analysis doesn't work. And I just laugh. It's like, okay, you don't want to follow technical analysis. Do it on, go out on your own. Try and follow what's going on in the market without technical analysis. That's going to be an interesting task. Anyhow, we did hit that center line. We hit back the 50-day, and now we've got the 10-year treasury yield moving higher and breaking out and threatening 11-year high. That is not good action. Not so much. I've said this over and over again. 3% interest rate, 3.25% interest rate historically is extremely low. That's not the problem. The problem with interest rates is the fact they're going up so fast. We were at 1.25% in August, under 1.25%. Now we're over 3.25%. That's a big hit to the economy. And we're starting to see it. I talked about a recession back at the beginning of the year. We did just get our first negative GDP reading. We're probably going to get another one. And, I've been watching some of these analysts say, well, yeah, the odds are increasing that we could have a recession in 2023. And I'm just listening. I'm like, what? Are you not looking at anything this year? I mean, we're starting to see initial jobless claims move back up again. Last week, 20,000 over expectation. It's been like 5 weeks in a row now. Or there might have been one where we were a little bit below expectations, but basically last 5 or 6 weeks, initial jobless claims been going up. We've had sentiment dropping. Consumer sentiment's been dropping was dropping for over a year. These are things that lead to recessions. So I don't know. And then crude oil jumping. I mean, if you go out and you spend money on crude oil, it's going to be less money you're going to spend other places. Because I can promise you, if you're putting gas in your tank, you're cutting a little bit more of a piece of pie out of your budget each month because gas prices have just skyrocketed. All these things, in my opinion, are adding up and leading to a recession. And I think we're in one. You won't find out probably another few months, but I think we'll find out that we're in one. And you know what? By the time we're in one and they announce that we're in one, I would almost guarantee you the market had bottomed before that. Market will bottom before the worst news hits. All right, S&P 500. Well, there's the close. There was the prior closes right here. I think it was 3,900.79 was the close back here on May the 19th. Yep, May 19th, 3,900.79. Oh, isn't this just nice? We closed at 3,900.86. So we spared 7/100ths of a point in the index. I don't think that's going to be an issue taking that out this morning. Just right now, Spider is down 2.3%. It's down $9 to 380.68. So if we pull up the Spider instead of the S&P, so there we are, basically closing back down at this low. But we're right now in pre-market with 11 minutes to go before the market opens at 380. We're all the way down here, 380.68. That low was 380.54 that day on May the 20th, the day after we had the low close. And that was a short-term capitulatory bottom. And look what happened afterwards. Now here we are right back down here and probably going to take out that bottom. I can't imagine. We got the Fed on deck. Fed tomorrow. They start their meeting, and then Wednesday they'll make their announcement at 2 p.m. I'm suspecting they're going to raise 50 basis points. There's some talk now, 75 basis points. either way, I cannot imagine that the Fed, in their language, is going to be anything but hawkish. And I don't know how that settles the market down, the stock market, or the bond market for that matter. And if the bond market, if we see the yields go through 3.25, a sustained move through 3.25, I think that spooks the stock market. Again, I don't see how rates go screaming to the upside and the stock market accepts it as being okay. I just don't see it. I think the growth stock's still under pressure, and that's a problem. Now, if I do, let's pull up the S&P again, and I want to show you just a couple of the things that I've talked about. So one thing that we want to look at is the XLY, XLP. And I always do a line chart. And then let's do the large cap growth. I do this a couple of different ways. We can do IWF, IWD. Another relationship. This is just intermarket work. This is the stuff that, again, I kind of was inspired to start looking at after reading some of John Murphy's work. And anybody who wants to read a book about the market, you want to buy John Murphy's books. I think he has a really excellent way of presenting complicated subjects in a very easy to understand way. And, I think that's a hallmark of some of his work. But let's pull this up. I'll make it a little bit bigger here. All right, so here's that S&P 500 coming back down to those lows. Here's the XLY, XLP. Now, one positive, and at some point we're going to go down and put in this low, maybe some kind of a capitulatory low. This is one thing that I am looking for in trying to call a bottom. Now, we don't know where this is going to bottom. We don't know where this is going to bottom yet. But if we go down, we have a capitulatory low. Let's say we get to 3,500, and this ratio does not go down to a new low. That would be one check mark in the bulls column of a bottom being in place. Just one check mark, a pretty big one, but it would be one check mark. So let's see where this low goes. I mean, we don't know. It could be today. It could be 4 days from now. It could be at 3,800. It could be at 3,500. It could be 3,200. I don't know. When the market sells off in a panic mode, it's hard to just say, well, this support level is going to hold. I mean, it's like, soft butter and you got a sledgehammer in your hand. You're like, it's going to pretty much just smash and go right through. That's kind of what happens when you get the sentiment to a point where we are now. And we're going to have margin calls with Bitcoin and Ethereum and all these cryptos getting hammered over the weekend. I could see this really escalating this week. I hope I'm wrong, but I wouldn't be surprised to see it escalate. And if it does escalate, what happens to this ratio right here? Going to be a big tell on the market. IWF, IWD, also still a little bit higher. The large cap growth versus large cap value right here, DJUSGL versus DJUSVL, also higher. Now, what I want you to understand, though, is that each one of these prior lows, every one of these ratios were setting new lows. That tells me that this bear market is still in force. Wall Street's not repositioning into growth and into discretionary versus staples. So why should we? Let Wall Street tell us. They're not going to tell us on CNBC. Who knows what they're going to tell us on CNBC? This is what they're doing with their money. Forget about what they're doing with their lips. I could care less. This person from Goldman Sachs, oh, yay. What's Goldman Sachs doing with their money? They got a lot of money. All these Wall Street firms, it's going to show up on the charts, how the money's rotating. Again, you got to ignore. And people were saying, oh my gosh, the news is so bad. We couldn't possibly be bottoming. Well, why? Because you're listening to the news. Stock market doesn't bottom when the bad news, at the crescendo of all the bad news. That's not when a stock market bottoms. It bottoms ahead of it, just like it topped way before all this news started. Nobody held up a sign and said, well, other than EarningsBeats, and said, we're in trouble here when the market was at an all-time high. And then when the market goes down 20%, then everyone's coming out and saying, oh, we've got a bear market. Be careful. Well, by the time you get to 20%, many of the bear markets are over or almost over. It's too late at 20%. Now, if it turns out to be a secular bear market, then getting out after 20% is not bad because the market will go down. You know how many secular bear markets that we've had where we've gone down more than 20 or 30%? I can count them in my lifetime on one hand. So is this going to be one of those very infrequent secular bear markets? It's possible. Again, not likely. Anyway, so that's, kind of looking at the S&P versus growth. What's going on with Bitcoin? Look at this. So we had this huge move up. First half of 2021, we set the high up 65, 70,000 on Bitcoin. Actually, the high was 70,000 in November, which, by the way, was when growth stocks topped as well. So this whole move down kind of coincides with exactly what we've been seeing in the growth versus value, that ratio. But anyway, we had this low here at 30,000. We had this low at 30,000, multiple lows at 30,000. Here we got, just down below 30,000 and went sideways right around the 30,000 level. And then boom, fell apart. So if we take a look at this now, just over the last 6 months, kind of zero in, look at the building up. I mean, this is almost like an avalanche of selling that is just building, building, building. And look at where we are right now today, down 3,200 points on Bitcoin to 23,411. So that was 26, roughly 26.6 before today's action. And that was already a pretty big drop from what we saw recently. This is panic mode. This is probably the start of some sort of capitulation. And the thing is, you might say, well, capitulation, I better get in. The problem is you don't know how far it's going down before the full capitulation is in. It could be here. Here was a big move down. There was capitulation. You can see we came rallying back off, went up for the next couple of days. Actually, 3 weeks later, we were up pretty nicely off that earlier low. But what if you thought this was capitulation right here? 3 days later, you'd have been down another 20%. And that's the problem with trying to call this and say, oh my gosh, this is capitulation right here. I need to get in. Well, I mean, we could be under 20,000 in another couple of days. I mean, who knows? Maybe it's today or tomorrow. When the margin calls start hitting and panic hits Wall Street, these things, we go down in a hurry. I mean, here, big move down. Looked like, okay, we're rallying. Then one final little scare. I mean, it's so hard to say. You got to see these big reversals before even thinking about getting in. And then the problem is, once you get the big reversal, where do you put your stop? If you're going to put your stop in at this tail down here, you got to give up probably 10, 12, 14%. Same with this bottom going down. There's that long tail. Looked like we were bottom turning up, and then one more head fake. And then we go up. Here we go up, for sideways for maybe, a month. And now we're breaking down again. We will undoubtedly, in my opinion, get some sort of a, capitulation, and we'll get a reversing candle and have an opportunity to trade Bitcoin. But is this it? Are we ready to make the prediction that this is going to be a long tail and we're going to finish back up at 26,000 today? That's a bold call. If it happens, great, congratulations. But if it doesn't, you literally could be down 20% in 2 days. That's the problem when you get into a capitulation. When you look at the S&P 500, you think, oh, this is capitulation. We're at 3,800. How can it go any lower? We could be at 3,500 before the end of the week. It's possible. The market, there's no rationality at all, or no rationale in the market when fear grips the market. The moves to the downside can be extremely swift and painful. So this is going to be an interesting week, no doubt. And I just don't think the Fed's got ammunition this time. You know, we've always in the past, the last 10 years, counted on the Fed to come through and, you know, initiate some new QE or some new program. They got inflation to contend with. And I think they've already made their statement that inflation now is their number one concern, not the economy. And I think that's bad news short term for the stock market. All right, let's see. What do we got? Oh my gosh, it's 9:30 already. I had so many things to talk about. Well, I'm going to keep going here just a little bit. Ethereum, same thing as Bitcoin, breaking down below that 1750 support area. Where is it going to be? I don't know. Today, next, 2 or 3 days, who knows? It's really hard to project how low something goes when panic hits the street. Now, just to show you something, this was I just forwarded the email I sent out to members on Monday. This is our daily market report. And in the market outlook section, this was back on Monday, June 6th, right here. That was the intraday. It was June 6th, 3:15 in the afternoon. And I was looking at this island cluster after this move up, basically just this consolidation period. And I said, beware this candle. And I was just looking ahead. Now, I did happen to do it at the end of the week, that week, which just happened to be coincidence. I'm not that good. But what I was worried about was starting the next move lower. And that's what, just studying history the way I have, when you're in a cyclical bear market or even a secular bear market, when you get these rallies and then you start to hesitate, you really want to pay attention to when you get that next move to the downside. So right in here, things were still looking pretty good. We had, nice little move up. And normally I would say, hey, we're in a bull flag. This market's going higher. The problem is this is a short-term bull flag and we're in an intermediate term downtrend. So calling bullish patterns to go against that overall downtrend, probably not a great strategy. Just like when we're in a secular bull market advance and people start talking about, oh my gosh, I think I see a head and shoulder top. And I'm like, so? I mean, the way I look at it, that neckline, that's just holding support. In a bull market, I'm not looking for a topping pattern. I'm looking for a reason to go long, not to go short. Well, here in this kind of a market, if your preference is to either be on the long or short side, what you're looking for is a signal to tell you whether you want to be long or short. That is a very bearish candlestick. Now, having shown you that, this is what happened on Thursday. So here was the Monday where we were on Monday, and there's where we lost the 20-day and we lost this support from this consolidation. Look at the PPO turning over just below the center line, starting to roll back over again. And then big red candle, big red filled candle, volume picking up both days. And now we've got this morning. This didn't just happen this morning. This started happening late last week. Look here, we came down here, went sideways for a while. Turned out, ended up breaking back down. That started the next leg lower. Here, at the end of 2021, beginning of 2020, I mean, this is more of an extended period of consolidation, but there's a support level. When that support level was lost, that's what began, that's what confirmed the start of the cyclical bear market. Then we go back up and we go sideways, a little cup here. This looks like a really bullish pattern, right? Move up and a cup. Isn't that a bullish continuation pattern? Well, ordinarily it would be, but guess what? We just went into a cyclical bear market. So no, I wouldn't view it like that. And then back down again. So you just got, these are like continuation moves, in my opinion. And so first test is a support level. Doesn't look like that's holding. Let me just give you the numbers right now. Right now, the NASDAQ's down 296 points. Dow's down 546. S&P's down 87 to 3,800. I'm going to keep going just a little bit longer this morning. If you need to go, you can always come back, check out the recording later. Go over to YouTube and check it out. But I think there's still a couple more things that I wanted to point out here. It's probably going to take another 10 minutes. So if you need to go, like I said, you can come back and check things out. So this was back on January 23rd. 4 predictions about this bear market. Basically, I was just saying this is a, potentially a cyclical bear market. I pulled up the quarterly chart here on the S&P 500. You can see that was pretty ugly, a little different than everything we had seen in the previous 7 or 8 quarters since the pandemic. NASDAQ, same thing. And so what I did is I went back through and I said, okay, based on what's going on, here's my 4 predictions. And I thought these were pretty bold. First, this was again back in January. The perma bears will claim victory in the next depression. That was in January. I think I'm pretty much right on at this point. A lot of the perma bears that call the tops every year now will claim victory, and they are. They're claiming victory. When you constantly during secular bull market advances saying the market's not going to go higher, 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 broken record, say it every year. When it does go lower, you can go back and say, look at me, I'm a genius. I called it. I said it was topping, and it did. What a great call I made. When the fact is they're just a broken clock. Don't pay attention. I wouldn't pay attention to anybody who's always bullish, and you might have thought that was me. Hopefully now you realize it's not. I wouldn't pay attention to anyone who's always bullish or anyone who's always bearish. They don't see the other side of the market. How can you be objective? How can you ever make an objective call if you're always calling the same thing? Now, when you're in a 10-year bull market, secular bull market like we've been in, it's pretty easy to stay on the bull side, which is what I stayed on most of the time. But like I said, we got issues. Other thing is here, second thing I'd just point out, it's cyclical, not secular. I guess history will find out whether or not I'm right on that one. I said gold will soar. This was probably the one I got wrong. Not that gold, I mean, on a relative basis, gold has been soaring relative to the S&P, but the actual price of gold, it's up, but it hasn't soared. So I would just say that one is, I guess we'll see whether or not we get any kind of more movement to the upside in gold. But I do think the relative strength of gold is important to realize whenever you're in a bad market. And this is the big one. This is the big one. Sentiment will be reset. And when I went through this, I mean, you can just see, on the Netflix chart, the big breakout here, and then the huge decline that Netflix has been in. But really, it's just about the VIX, the equity-only put-call ratio. The market had just been seeing nothing but prices going higher for 20 months. All those new investors that came in after the pandemic saw nothing but a rising market. They didn't know what a bear market looked like. It's like, okay, somebody mentions something, one of the Reddit folks says, buy this, and everybody just piles on, and it's just this great big financial scheme or whatever you want to call it. And you're just going to make a ton of money. Well, I don't hear much about those folks anymore. This is a painful lesson. When I first started trading in the market in the early 1980s, we were coming out of a bear market and everything just looked peachy. I mean, the market just kept going up. And so I started dabbling. I started getting a little bit more money in by the mid 80s, 86, 87. I had built up a little nest egg, and then I watched the market crash, just completely wipe out my portfolio. And I was into a lot of aggressive stuff. I know the feeling that anybody who's got into the market the last 2 years, I know what they're going through right now because I went through it. But you learn over the years from many mistakes, and hopefully you don't repeat them. Maybe you'll make some new mistakes. Hopefully you won't repeat the old ones too many times. Anyway, sentiment needed to be reset. We've been seeing that. So I thought that was kind of cool. The other thing I talked about here, and this is on January 4th. So I talked about the S&P 500 and the fact that we were moving up. But if you read through this thing, through this initial paragraph, I was talking about rotation was moving into value away from growth. That's not good to continue to sustain a market like that. So right here, aggressive sectors continue to weaken on a relative basis, and that puts the current rally in considerable danger. That was when the market was at 4,800. That's not telling people we're in a bear market 4 or 5 months later. But the bold call for me was Apple. I saw negative divergence on the weekly chart, or excuse me, this is on the daily chart. but we saw these negative divergences, and we've seen some pullbacks after these divergences. So Apple was at 180. And I went on to say, where was it? I just started talking about some of these big drops that Apple's had in the past. And so this paragraph right here, I said, cannot ignore the fact that Apple's gained 58% since the last inflation-related sell-off from January to March 2021. 58% Apple went up. That sell-off was 20% over 6 weeks. So again, just recent history. So I just pointed out a simple pullback to test trendline support near 140 would represent slightly more than a 20% decline. And so I asked the question, do you think it's possible, or do you think this isn't possible with inflation worries escalating? Be extremely careful trading growth stocks right now, even the best of the best like Apple. That was January 4th. Now, if you want to see where Apple is now, it's at 133. It's below the 140 level. So this is where I was talking about. Look at what's happened to Apple. Apple's a great company. I mean, I can't think of any other company that I would probably own, except probably now. I think I'd rather own Tesla than Apple. If you told me we had to hold a stock for 5 or 10 years, pick one, I think for me it would be Tesla over Apple, but Apple would be way high on my list. It's a great company, but that doesn't mean you don't go through periods like this and like this and like this and like this. It happens. So you got to read everything else going on in the market, not just whether Apple is a great company. Of course, everybody on CNBC is telling you Apple is a great company. I'll tell you it's a great company, but that doesn't mean it can't go down 20, 30%. There was another prediction I talked about where I thought Apple could go to 120. I think what I was doing is showing in the past how it's dropped 35% on many occasions. And I think 35% would take us back to about 120, maybe even a little bit below 120. So yeah, I think that that's still possible in the way the market's going. I think it easily could happen. I mean, we're almost there at this point. Last two things I'm going to say real quick. I'm sorry this is going so long, but obviously we got a pretty bad market. And I just want to make sure I get all these things out. You can do with it what you want. The volatility index bottoms generally hit when in cyclical and secular bear markets. The bottoms normally hit. Now in a secular bear market, this is probably just, these are temporary bottoms. In a cyclical, they can be the ultimate bottom. But normally I look for bottoms when I start to see the VIX is trading up at, in the mid to upper 30s, especially if we get into the 40s. That just doesn't happen very often. And when that happens, you can almost be assured that the baby's going out with the bathwater, the kitchen sink's being thrown in, and we're in the midst of some sort of capitulation. Now, this was earlier, so let me update this and give you the actual VIX reading. This is where we closed on Friday, 2775. Right now, we're at 3328, so we are rapidly moving up in the VIX back toward these recent highs in 2022. And the fact that it's at a high tells me the market is probably not doing well. And I'm seeing right now, the NASDAQ now is down 348, Dow's down 680. This could be capitulation today, or it could just be getting started with the Fed maybe coming through and just adding to it the next couple of days. I don't know. What I've said that is if you're a trader, cash is a good position to be in. And I can't tell you how many times I've been very, very thankful I've been in cash when I wake up in the morning. And today is one of those mornings. Last thing I want to point out here is the equity only put call ratio. So the VIX and the equity only put call ratio are the two sentiment that I like to use. There are some that like to use these, AAII studies, and, they're asking people, what do you think about the market? Oh, I'm bearish. Oh, I'm bullish. Okay, that's great. What are you doing with your money? That's what I care about. Are you selling? Are you panicking? Well, this is the VIX and the CPCE are telling us what people are doing with their money. The CPCE, equity only put call ratio, I think is probably the best barometer of the retail trader, the novice, the I'm just going to buy options because that can make a lot of money. A lot of them don't know what they're doing. There are a ton of really good options traders, by the way. So if you're listening in and you make your living trading options, I'm not talking about you. I'm talking about people who really don't understand options. They don't understand the market, and they just want to just throw money hoping to hit it big. It's almost like they're going to Vegas. Let me just put all my money out on the craps table. I think, we're going to hit the number. We're not going to get a 7, not going to crap out. Well, the market has a tendency of crapping out on retail traders. And so when the retail trader gets to extremes, normally that helps us direct the stock market. And so the put call ratio right here is up to 0.9 or 0.89 on Friday. I can only imagine what we're going to get today if we keep doing this. You can see this is the highest reading. Friday was the highest reading in the last year. And the 5-day moving average now has a really good shot to get above 0.80 on this move, which 15 of the major bottoms, 15 of the last 18 major bottoms this century have come with this 5-day moving average above 0.80. All 18 have come with the 5-day reading being at least 0.75, which we have already hit, by the way. But this could be the one that takes us to 5 days over 0.80. So we're getting there. Remember, I said the sentiment will be reset. This is it. And it took all this selling to get us there. Anyway, that's all I got for today. I'm skipping the 3 you must see. There was a bunch of others here I think you must see as well. So we'll just count that. Anyhow, I'll be back tomorrow over at Stock Charts TV at 9 a.m. for your next show. Again, apologize for the length of today's episode, but I did want to go over a lot of things. I think this is a big time in the market. Have a great day, everybody. Hopefully see you over at Stock Charts tomorrow. Happy trading.